Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Cindy Beaulieu, Chair of the Investment Policy Committee, Managing Director and Portfolio Manager of Conning, to discuss the current role of stocks versus bonds in portfolios. Cindy, it's great to have you with us. Welcome to Trade Talks.
Thanks so much, Jill. Great to be here.
You got it. Let's start with your outlook first. What is your outlook for the rest of 2023, and what informs it, whether we're thinking about geopolitics, the economy, elections, the Fed? How is all this playing into account with your outlook?
Sure, and there's certainly a lot to digest right now. But, if you think of geopolitics, we're keeping a very close eye on China and Taiwan. We don't see it as an imminent threat, but certainly something to keep an eye on. For politics, 2024 feels like a long time away and a lot of candidates to get through. So that's maybe a little bit more on the back burner. We're focused on growth, inflation, and the consumer right now, much like the Fed. We've had resilient growth. We've had inflation moving towards the Fed's 2% target, but we think that could take a little while longer. The consumer has been unrelenting, but we see signs that maybe the consumer is getting a little bit tired here. So focusing on those three things keeps us very much focused on the volatility that we have seen to this point. And we expect that that's going to be with us for the balance of the year. It's been primarily in interest rates, but certainly leaking into the equity markets as well.
Let's talk about that more. Are market observers right to downplay a recession? And can you elaborate on why historically it's been events and not interest rates that can trigger a recession?
Yeah, I think one of the challenges this time around is what really got us here, which was the pandemic and causing so many different situations across the economy. It's been a lot harder to call this recession. We've looked at it as a rolling one. If you think back to housing in the second quarter of 2022 into the third quarter, manufacturing in the fourth quarter of 22, and now we're waiting for the consumer to crack, as I said. I think between savings rates coming down, student loan payments coming back, and the job market getting a little bit more tricky, the consumer, we do think, is actually going to finally give into all of this, probably late first quarter, second quarter of next year. And that's where we get the third leg of this recession, expected to be short and mild, but we do still see it coming. I think that's been one of the challenges for a lot trying to call this one.
And generally speaking, how would you characterize the current role of stocks versus bonds in the portfolios Conning is managing at this point?
Sure. So we manage money for both life insurance companies and property casualty companies. Life insurance companies tend to have a modest weighting to equities, really, if any at all, while P&C companies tend to have a much larger weighting. And so what we've seen with the run up in equity valuations this year is a willingness to reposition back towards fixed income and appropriately stay with their strategies. And it's been a time where you can lock in some attractive rates for those P&C companies. On the life side, while they don't necessarily play the pure equity markets, a lot of that money goes into the alternative spaces, which was growing over the last 5 to 7 years. But what we've seen more recently is that that's really kind of stayed more steady, and more of the liquidity is going back into public fixed income, again, because the all-in yields are just so attractive. It makes sense to lock them in.
So really, for these insurance companies, they are probably the most interest rate sensitive of, the different companies that you manage.
Yes, absolutely.
All right, Cindy, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Sure. Great. Thank you.